Let's take a look at the difference between a statutory engagement or a statutory audit and a non-statutory audit. When we use the word statutory in our studies, it basically means something that is required by legislation. Statutory means that there is a statutory law around that, and in terms of our audit, what it's saying is that certain audits are required by law. The company law, the Companies Act, requires an audit to be done. That means that for us as auditors, our job is laid down by company law. It's not just about what the company wants, it's not just about what we want, it's actually laid down by the law that governs the companies itself. So there are audits that are required in terms of statutory law. So if a company is required by law to have an audit, they have to comply with that. They have to have an audit. They do not have a choice. In other cases, we use the word non-statutory audit. In other words, we can talk about this as a voluntary audit. The company is not required to have an audit by law, but for some reason they believe that it will be good for them to have an audit. In what cases would a company decide to do this? In most cases, it comes back to the idea of what the users want. The reason, again, that we perform an audit is to add credibility to the financial statements on behalf of the users or for the user's benefit. If a user is going to be making a decision about giving the company a loan or investing in the company, they might feel much more comfortable. They would definitely feel much more comfortable if an auditor had performed an audit on it. But just because an auditor performs an audit doesn't necessarily mean that it is statutory. So under certain circumstances, the company law requires an audit to be done. That is a statutory audit. If the company decides to voluntarily have an audit done, that is called a non-statutory audit. Under what circumstances would the difference between these two come up? Under what circumstances would we have a statutory audit versus a non-statutory audit? A few years ago, the company law used to state that any company, any organization that was opened underneath the Companies Act, a company had to have an audit, regardless of the size, regardless of their turnover. Every company had to have an audit. In the latest company law, however, that has changed. Not every single company has to have an audit. In some cases, they can have what we call an independent review. An independent review offers a level of assurance that is lower than a statutory audit. So a statutory audit would give your users more assurance, where an independent review would give the users less assurance. The question is, under which circumstances now are you allowed to have, or is your company allowed to have, an independent review rather than a statutory audit? The company law lays this down. The Companies Act tells us under what circumstances a company is allowed to use an independent review rather than an audit. And obviously you'll find that a lot of it comes back to what the users are looking for, or the understanding that in certain circumstances the users are going to need more credibility than others. And the company law is very specific about exactly what circumstances you have to have an audit. So let's take a look at the circumstances or the difference between those two. The Companies Act talks about a public interest score. You'll find that they, in a lot of cases, will abbreviate this to your PIS, your public interest score. And this is calculated on the basis of certain details within your company. The first one we start off with is your employees. The average number of your employees throughout the year. So for the year ended, we take the average number of employees, and whatever that average number is, each of those employees get a point. So we take a certain amount of points. If, for example, you had on average 30 employees throughout the year, then your company will have 30 points. Okay, so for every average employee you had during that year, you are allocated, or your company is allocated, 30 points. Your turnover, you get 1 point per million. So for every R1,000,000 turnover that your company makes, or part of R1,000,000, you allocate 1 point. So if your company made R1.5 million through the year, your company would get 2 points. The turnover, you can see the higher your turnover is, the higher your points would go. And that obviously is an indication of the amount of interest that various stakeholders in the community around your company would be interested. Third-party debt is important. Again, the same as turnover. You get 1 point for every million or part thereof. So again, if you have R1.5 million worth of third-party debt, you would get 2 points. Again, in this case, what we're trying to say is the more third-party debt you have, the more external users are going to be interested in your company's financials. Third-party debt is anyone outside the company, so banks, finance houses that are giving you finance. Your shareholders, you get 1 point for every shareholder. Whoops. So for every shareholder that you have, not for every share, but for every shareholder, you get another point. So you have 1 point for every R1,000,000 turnover, 1 point for every R1,000,000 in your third-party debt, and 1 point for every shareholder. And our score, either between 100 or 350. If you have a score that is higher than 350 after adding all of these together, then you have to have an audit. If your score is below 100, then you don't need an audit. You can have an independent review. So the Companies Act is quite specific about calculating these and says you've got to make sure that you are comfortable, and you've got to make sure that if there is a higher external or higher users interest in your company, then you need to have an audit. If there are not that many outside interests in your company, then you don't need to have an audit. The difference between these, the difference between 100 and 350 is going to depend on whether your financial statements are compiled internally or externally. When we talk about the compiling of your financial statements, it means taking all the transactions that happened through the year and putting them together, summarizing them into your financial statements. If you do this in-house, in other words, if you get your company, your bookkeeper, your accountant to prepare your financial statements, that is considered internally compiled. If you employ a company, an accounting company or an audit practice to compile your financial statements for you, that is considered external. Again, the question of why this comes up or why the company law creates this or says this comes down to the concept of assurance or credibility. If you were an investor, if you were someone who was going to invest in this company, would it make a difference to you if the financial director of the company put the financial statements together, or if a separate third-party company put the financials together? I would definitely feel more assurance, and I would feel more comfortable if an external party did that. Keep in mind that even though our financial statements are externally compiled, compilation is not an audit. All a compilation is taking all your financial information, all your transactions, your sales, your financials, putting them together and creating a set of financial statements. There is no assurance in a compilation engagement. All it is creating a set of financial statements according to the relevant framework. But we are saying that you would feel more comfortable if an external or a third party created and compiled your financial statements. So between 100 and 350 points, the differentiator is going to be whether your financial statements are internally or externally compiled. If your financial statements are externally compiled and you are sitting between 100 and 350, you will be allowed to have an independent review. If your financial statements are internally compiled and you have a number between 100 and 350, you will have to have an audit itself. So the difference here we're looking at is both your public interest score in terms of adding all of these up together, as well as the question of whether or not your financial statements are internally or externally compiled. Again, please remember that a compilation does not add assurance. However, a third party would definitely feel that your financial statements would be more accurate if they were compiled by someone who really knew what they were doing, an accounting officer, an audit practice, an accounting practice. But if you do get an audit firm or an audit practice to compile your financials, keep in mind that the same audit firm would not be allowed to compile your financials and audit them. They would have to be done separately. So your public interest score, two components: the calculation of your employees, turnover, third-party debt, and shareholders. How many points is that? If you are underneath 100 points, you get you can have an independent review. If you are 350 and above, you have to have an audit. And between here, your decision driver is going to be whether or not your financials are internally or externally compiled.